today, the presentation that I will be presenting contains information that are valid only since May 2nd, 2018. Actually, May 1st, 2018. So why does the resolving insolvency indicator matters? This is the first topic we're going to be discussing today in this indicator. So we realized then when there is a good insolvency regime, it helps creditors achieve the maximum value of the assets. So here we're talking about how much they would recover when there is a debtor that enters into an insolvency procedure. It also allows to restructure any viable business in order to avoid having to go through liquidation, possibly. It also enhances the certainty in the market, and it promotes economic stability and growth. It also pushes lenders to grant higher risk loans as they know their returns would be protected. It also results in more employees keeping their jobs. This is especially true in the case of restructuring. It also helps preserve the network of suppliers and customers. So let's talk a little bit more about what the resolving insolvency indicator measures and what it doesn't. First, the indicator is divided into two indices. The first one talks about the recovery rate, and I'll talk in a little bit about what the recovery rate indicator includes. And the second part talks about the Strengths of Insolvency Framework Index. This index measures the quality of insolvency laws that are applicable to liquidation and reorganization proceedings. This index is solely based on the law, and it's composed of four indices. The first one talks about the commencement of proceedings, the second about the management of debtors' assets, the third about reorganization proceedings, and the fourth about creditor participation index. And we'll talk a little bit more in details in future slides about each of these four components. The recovery rate, on the other hand, calculates the cents on the dollar that would be recovered by secure creditors in case of either reorganization or liquidation or debt enforcement proceedings. The recovery rate is calculated based on the time that it needs to resolve one of the reorganization, liquidation, or foreclosure proceeding that I just discussed, and the cost to go through one of these procedures, and what would be the outcome of these procedures. So basically, are we going to sell the company, for example, as a whole, as a going concern, or are we going to divide it into assets and sell it as piecemeal? The resolving insolvency indicator does not measure the bankruptcy of financial institutions or of natural persons. So again, there is a specific set of case study assumptions that we look at and that I'm going to go through in a little bit. It also does not measure any sector that is different from this case study. It does not measure the recovery rate of unsecured creditors, so we only focus on the recovery rate of secured creditors. And we do not look at what could happen outside court. So we know there are sometimes some possibility of restructuring or enforcement outside of court. We don't look into that, even though this is what normally would happen in an economy. We only look about what happens within the court. So let's talk a little bit more about the recovery rate and how it's calculated. Again, in general, the recovery rate is going to include the time, the cost, and the outcome to go through either reorganization, liquidation, or foreclosure proceedings. And here we're talking about what would happen to secured creditors. The time that is calculated is measured in calendar years. So it's not calculated based on days. So it's only based on years. We also take into account any appeals or requests for extensions that are normally done within such procedures in an economy. The cost required to recover the debt is calculated as a percentage of the debtor estate. It also includes the court fees, the fees that will be paid to insolvency administrators, if any, what would be the fees paid to lawyers who will be representing this case in front of the court, and what would be the fees for assessors if there is a need to assess the value of the property, and to auctioneers as well in order to conduct the sale. Also, in some other countries, we know that there are some miscellaneous fees, so we also look at anything that will be paid in order to go through such an insolvency procedure. The outcome is divided into two possible outcomes. The first one is selling the business as a going concern. So here we are assuming that there will be, for example, another company or another individual who's willing to buy the business as a business. And the second option will be selling the assets of the company as a piecemeal. So here we'll be selling the assets, not the business. The recovery rate, as I mentioned earlier, measures the cent on the dollar that would be recovered by secured creditor only. And here we talk about the present value of the debt that is recovered. And it only includes official costs for the insolvency proceedings. We also take into account the depreciation of furniture, and we look at the outcome for the business that would affect the maximum value that can be recovered. So what are the case study assumptions for the recovery rate section of the resolving insolvency indicator? The case study focuses on a limited liability company that would operate in the economy's largest business city. So in the case of Azerbaijan, that's Baku. We assume that it's 100% domestically owned, with the founder owning 51%. So we don't have any foreigners owning part of this limited liability company. We assume that this limited liability company has a downtown real estate where it runs a hotel that would be valued at either 100 times the income per capita or $200,000, whichever is greater. We also assume that the limited liability company has 201 employees and has 50 suppliers, and each of them is owed money from the last delivery. This business also took a 10-year loan agreement from a domestic bank, and it secured it with the hotel property that we discussed earlier. We also assume that this business is experiencing financial difficulties. It had negative net worth in 2018, and it's also expected to incur losses in 2019 and 2020. We assume that as of the beginning of the year, there was no cash to pay the bank interest or the principal, and they're all due on the second day, so on January 2nd, 2019. We assume that the cash flow for 2019 will cover the operating expenses, but it will not cover any payment to the bank. The amount that's outstanding under the loan agreement is exactly equal to the market value of the hotel, and this represents only 74% of the total debt that the company has. So we still have 26% debt owed by the company to unsecured creditors. If the hotel is sold as a going concern, we assume that it will fetch 100% of its current value. However, if it's sold piecemeal, so here if we're doing a sale of assets, it will only fetch 70% of its value. And here is the importance of what is the outcome, basically, of this case. In the past 5 years, so in Doing Business 2015, there were some methodology changes that were introduced to the indicator. So originally, this indicator was only focused on the recovery rate index. So it only measured the time, cost, and outcome to go through an insolvency procedure. In Doing Business 2015, we introduced a second index, which talks about the legal framework for insolvency procedures, and which is based on the law. This helped develop a more accurate ranking of economies, as it also evaluated the quality of the legal framework in addition to the efficiency of the proceedings that were measured previously. It also helped capture practice better, And it provided clear guidelines for insolvency reforms as well, as we are now looking at the wordings of the law in addition to the practice. And we consider the good insolvency practices that are identified by the World Bank Principle and the UNCITRAL Legislative Guide. The Strength of Insolvency Framework Index is divided into 4 different indices. The first one is the commencement of proceedings. It assesses the availability of liquidation and reorganization to both debtor and creditors. And it also measures what are the standards to start insolvency proceedings. In the management of debtors' assets, we evaluate the possibility of continuing or rejecting contracts during insolvency. We also measure the possibility of avoiding preferential and undervalued transactions. And we look at if there is a possibility of having post-commencement finance. In the Reorganization Proceedings Index, we look at the approval and the content of the reorganization plan. In the Creditor Participation Index, we look at the creditor participation and the rights within liquidation and reorganization proceedings. All this index has a maximum score of 16 points. So, as I mentioned earlier, this index measures whether the legal framework is applicable to judicial liquidation and reorganization procedures are in line with the good international practices that are defined by the World Bank's Principles of Effective Insolvency and Creditor-Debtor Regimes and the UNCITRAL Legislative Guide on Insolvency Law. In the Commencement of Proceedings Index, an economy can score a maximum of 3 points. It looks at the possibility for both the debtor and creditors to start judicial reorganization or judicial liquidation, together with a concrete mechanism for the commencement that will define the debtor's insolvency. So in other words, it would measure what insolvency proceedings are available to the debtor or the creditor and what are the bases to start such insolvency proceedings. The Management of Debtors' Assets Index has a maximum score of 6 points. It looks at what happens with the contracts and transactions and finance of the debtor company during the insolvency proceedings. The Reorganization Proceedings Index has 3 points. It looks at the provisions that govern the judicial reorganization. So here we only look at the possibility of having reorganizations that are formally regulated, that are based on a concrete plan, and that aim to restructure the debt so the debtor can actually re-emerge as a going concern. The final index is the Credit Participation Index that has a maximum score of 4 points. It tests whether the laws provide for specific safeguards that would protect creditors during insolvency proceedings. These safeguards would include the right to appoint an insolvency manager, the duty to approve the sale of substantial assets, the right to request information, and the right to object to the decisions of the manager on acceptance of claims. What are the main findings in the Doing Business 2019 report? In this slide, we see the top 10 performers worldwide. We have Japan at the top of the list, followed by Finland, the United States, Germany, Norway, Denmark, Netherlands, Belgium, Slovenia, and Puerto Rico, US. On the right, we see for each of these economies the recovery rate, and we see, for example, that in Japan, a secure creditor would recover 92.4 cents for each dollar that it lent. Japan also has a score of 14 points on the Insolvency Framework Index, and that is out of 16. In 2017-2018, there are 14 economies that did reforms on the Resolving Insolvency Indicator. Some of these economies have improved the likelihood of having a successful reorganization. They reintroduced a new restructuring procedures. They strengthened the creditor's right, improved provisions on treatment of contracts during insolvency, and they streamlined the insolvency procedures. So what are the global good practices that we discussed earlier? It is recommended to establish and promote reorganization and liquidation procedures. It's also recommended to eliminate formalities and introduce tightening time limits. It's also important to strengthen the creditor participation in these procedures. It's also important to clarify rules on how to commence insolvency proceedings. It's also important to improve the provisions of the law that have to do with the treatment of contracts and voidable transactions. And it's also important to introduce provisions on post-commencement financing. So here we're talking about financing that happens after starting a liquidation or reorganization procedure. And it's also important to regulate the profession of insolvency administrators. So what are the main findings in Azerbaijan? Here we're talking about, of course, the score of Azerbaijan in the Doing Business 2019 report. So the score here is only valid as of May 1st, 2018. It does not take into account any improvements or any reforms that may have been done after May 1st, 2018. Azerbaijan ranked in last year's report as 45 on the Doing Business, on the Resolving Insolvency Indicator. Here we can see the score of Azerbaijan in each of the recovery rate, time, cost indices. And we can compare the assessment of Azerbaijan to other countries in the region as well, and to the median score for Europe and Central Asia. In this slide, we can compare the result for Azerbaijan on the second part of the Resolving Insolvency Indicator, which is the Strength of Insolvency Framework. So again, this is based on the law that was in force as of May 1st, 2018. During the Doing Business 2019 report, Azerbaijan had major positive reform on the Resolving Insolvency Indicator. The new amendments have allowed the insolvency representative to apply to the court to invalidate preferential transactions that were concluded during the 6-month period preceding the initiation of the debtor's bankruptcy proceedings. This increased the score of Azerbaijan by 1 point on the Management of Debtors' Assets Index. The second reform focused on providing the secure creditors as a group to take part in the voting on the rehabilitation plan. And with that, we conclude the presentation for the insolvency indicator.